Yes, so you are to attempt it to see whether you can be able to manage to solve it. But now I want us we look at it together. So the question says, on 1st of January 2014, Ujenzi Limited was awarded a contract for the construction of a road. The contract was for 3-year period. The contract price was 250 million. The following information has been extracted from the books of the company. So for the year ended 31st of December, so that is the information you're having to be given there. We have the total cost incurred to debt, estimated additional cost to completion of the contract, billings which have actually been made during the year on the contract, cash received from the client on the contract in these particular years, then general administration expenses that were actually incurred for each and every year, that is 2014, 2015, and 2016. So required, using the percentage of completion method, prepare the following: the income statement extracts for the 3 years and the statement of financial position extracts for also the 3 years, So we can start by having to look at the income statements extracts, But of course, now in this case, we can be able to do a small working here. So we can have a working to determine working, so percentage of completion. So percentage of completion to get the percentage of completion, So of course, we have 3 years. So we have 2014, we have 2015, and we have 2016. So all these that we're having to talk about is actually having to be presented in shillings of million. So these are actually shillings of million. It is in shillings of million. So to get the percentage of completion, we said you'll take the cost to debt. So the cost to debt, then you add any additional estimated costs to completion, any additional estimated costs to completion, any additional estimated cost to completion of the contract. So then in this case, you can actually be able to get the total estimated cost. You'll get the total estimated costs. And in this case, in the question, for the cost to debt, cost incurred to debt, you've already been given. So this one is actually 80, this one is 170, and this one is 220. Remember, I told you the previous question we had, we were not given the costs to debt. We are just given the cost incurred in the year. So it means we were having to sum up to get for the second year and of course for the third year. But here, you've already actually been given. So also the additional estimated cost to completion have actually also been given. So for the year 2014, it is actually 120 million. And of course, for the year 2015, it is actually 90. For this particular year, we don't have. So when you add the two, actually you add, so this is additional. So this one becomes 200 million. And this one becomes, is it 260? 260 million. This one becomes, in this case, 220 million. So to get the percentage of completion, so we said you will take the cost to debt, you divide by the total costs. So the costs to completion, the percentage of completion. So already this one, I gave you the formula. So we said in this case, you take, this one is equals to the costs to debt. You divide by, in this case, the total estimated costs. So for each and every year. So it means for this particular year, we likely take, in this case, 80, you divide by 200. 80 divided by 200, and then you multiply by 100%. Of course, you multiply by 100%. This one, you'll take 170, you divide by 260, you multiply by 100%. This one, you'll take 220, you divide by 220, you multiply by 100%. So what is the percentage of completion here in the year 2014? What is the percentage of completion here in the year 2014? Mm-hmm. 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 So I can see you say, oh, you've already given me the percentages. It seems already you had computed. So it is 40%. You're giving me 40%. I can give 40%, 60%. There's already someone who had actually given me like all of them. Is it 60% or 65%? 65%. Then of course, now in this case, this one is quite obvious. It is 100%. 100%. So those are the percentages of completion of work for each and every year. So it is important that we calculate the percentage of completion because it is going to help us to know how much revenue will likely be recognized in each and every year. It will likely help us to know how much revenue will likely be recognized in each and every year. When now in this case, we are coming up with the profit and loss, or we want to know how much was actually made as a profit for each and every year. So once we've gotten the percentages of completion, then in this case, we can come up with what? The income statement. We can come up with the income statement extract. With the income statement extract, we can come up with the income statement extract. We can come up with the income statement extract. We can come up with the income statement extract. So the income statement extract. So but now in this case, you can just be able, before you start with the income statement extract, let's just get the revenue recognized for each and every year. Revenue recognized. Let's get the revenue recognized for each and every year. So for the first year, since we've actually been told that in this case, you've been told the contract price is likely 250 million. So it means in the first year, we'll likely be able to recognize 40% of 250 million of 250 million. In the second year, we'll likely be able to recognize 65%. So let's see, 65% of 250 million of 250 million. Then in this case, in the final year, we'll likely be able to recognize 100% of 250 million. 100% of 250 million. So when you do the computation, how much revenue will we be able to recognize here? It should be able to come to 100. So because this 4 by 25 is 100, this one is 100. So that is the revenue that will be recognized here. What about this particular second year? The second year, it will be 162.5. So 162.5. 162.5. This one will be 250. So 100% of 250 you get in this case that amount of 250. So once we know the revenue recognized, this one is the one that actually ends up having to help us to come up with the income statement, because that is the first item that you start with. Whenever in this case you are getting the income statement extracts. So if you are getting the income statement extract, that is the first item that in this case we likely start with. So once you have these ones, then now in this case we can now come up with the income statement extract. Income statement extract. So hope you've been able to copy this one. So already you copied. Revenue recognized is this one. So you can come up with the income statement extract. So of course, you say ujenzi, you present your work so well. Ujenzi Limited, income statement extracts. They are simply extracts. So it's not a complete one because we are just dealing with, for example, this particular specific contracts in the income statement. Extracts for the year ended, for year ended. Of course, we have 3 years here. So we have in this case 2014. So 2014, 2015, and 2016. 2015 and 2016. So that is what you have. That is what you have. Remember, in this case, we are dealing with shillings in millions, so they are not cows. So it is shillings in millions. These are not cows that are supposed to be vaccinated, but they're actually shillings in millions. They are not cows to be vaccinated, but they're actually shillings in millions. So we'll start with this particular figure here. So revenue recognized. Revenue revenue recognized, which you've already computed. So you just take, in this case, 100 million. You take 162.5 million, 162.5 million and 250 million. Then we less the costs that were actually incurred to debt. So less the costs, less costs to debt, the cost to debt, and the cost to debt you've actually been given already in the question. So for the first year, it is actually 80. This one is 170. It's 170 years, 170. This one is 220. 220. It is actually 220, like that. So with this, then now you can be able to get the gross profit, gross profit or loss on these contracts for each and every year. So you can less for the first year. This one is 20. This one is negative 7.5, negative 7.5, which is not a gross, it is not a profit, is a loss, is a loss. This one is actually 30. This one is actually 30. When you minus, you get that. Then we said on the gross profit that has actually been realized, you less gross profit already recognized, less GP already recognized, you less gross profit already recognized. And this one we said you will take for the previous year, because for the year 2014, they have already recognized 20 as a profit on this contract. Remember, it's just one contract they are dealing with. So here we'll have to, on the subsequent year, we'll have to less the gross profit which was actually recognized in the previous year. So for the first year, we haven't been told what was the gross profit in 2013. So there'll be nothing there. But the gross profit for the previous year for 2015 will likely be 20. Then in this case, for this other one, it will likely be 7.5. It will likely be, we less 7.5. We less 7.5. We less 7.5. We less 7.5. Less 7.5. So we'll get the gross profit for the year. We'll get the gross profit for the year. We'll get the gross profit. Hope you remember how this figure. So the gross profit already recognized. Remember what we said. You take the one for the previous year. So this, for this 2015 for the previous year is this one. For this 2016 for the previous year, it is actually that one. It is actually that one. So that is how you get that one. Then in this case, you get the gross profit for the year. You'll get the gross profit now. Gross profit for the year. You'll get the gross profit for the year. So this one, it will be 20. This one will be negative 27. So it will be negative 27, 27.5, negative 27.5. So this one is minus minus. So it becomes a positive. It is minus minus. It becomes a positive. So it will be 37.5. It will be 37.5. So when you take, is it board mass? 30 minus minus. So with 7.5, you get, I think you'll get a positive there. You'll get a positive there. So this one will likely be 37.5, 37.5, 37.5. Then we've been told there were some admin expenses that were incurred in the question. The last item in the table, the admin expenses, you less the admin expenses. Admin expenses. So the admin expenses for the first year, that is 2014, was actually 4 million. So for this second year, it was actually 6 million. And for the final year, it was actually 5 million. It was actually 5 million. 5 million. It was actually 5 million. So you'll get the net profit for each and every year for the contract. The net profit for each and every year for the contract. This one will likely be 16. So this one, when you minus, is negative 33.5. So it will be 33.5. So this one will be 32. Is it 32? 32.5. So 32.5. 32.5. And of course, these ones will likely be our net profit. These will likely be our net profit on this contract for each and every year. So 2014, 16 million, sorry. There was a gross loss here, net loss here. There was no profit. But for the year 2016, there was a profit of 32.5 million, 32.5 million, 32.5 million, 32.5 million, 32.5 million. So that is how, in this case, you come up with the income statement extract for Ujenzi Limited for each and every year, 2014, 2015, and 2016. Then now, in this case, we can get the statement of financial position extract. So statement of financial position extract for Ujenzi Limited. So statement of financial position extract for Ujenzi Limited. So hope you've been able to capture this one. Hope you've been able to capture this one. Who hasn't finished? Are you done capturing it? Are you done capturing it? Are you done capturing it? 10, Margaret 10. So I can see you are saying done, 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 done. So you are done. So we can now look at the statement of financial position extract. Statement of financial position extract. Statement of financial position extract. Ujenzi Limited, statement of financial position extract. So Ujenzi Limited, Ujenzi Limited. So statement of financial position extracts. As at, suppose there are 3 years. So you have, in this case, 2014. 2014, you can put the year here. 2014, 2015, and of course, 2016. 2014, 2015, and of course, 2016. So we have shillings in million, shillings in millions, shillings in millions. So shillings in millions. So we said for this one, you start with the cost to debt. You start with the cost to debt. Cost to debt. And of course, the cost to debt you are given in the question. You are given in the question, which is actually 80, 170, 220. So on this one, you add the gross profit to debt, the gross profit to debt. So the gross profit to debt is what you've realized as the gross profits in the income statement. So if you look at the income statement we've just computed up there, Apple Jew, the gross profit for the year 2014 was 20. It was 20. It was actually 20. So this one you add. You add the gross profit to debt. It was actually 20. So for this one, it was 7.5, which was not a profit but a loss. For this one, it was 30. It was 30. It was actually 30. It was actually 30. Then you less the cash they have been paid to debt, less cash received to debt. You less the cash they have actually been paid to debt. So the cash received to debt, you've been given in the question there. So in the question in the table, you can see 80, 90, and 70. So 80, 90, and of course, now in this case, 70. 70. So with this, we said when you compute this one, you'll be able to get the WIP or the work in progress. Work in progress. You'll get the work in progress, or what we refer to as the WIP. The WIP that the contractor will be carrying forward to the coming year. The WIP that the contractor will be carrying forward to the coming year. So I think this one is 100 minus 80. It is 20. This one is 20. This one is 20. So this one is 170 minus 7.5. I think it is 162.5 minus 90. Minus 90. Is it 72.5? Is it 72.5? 72.5. Is it 72.5? So let's see what has happened here. So the cash received on the contract in the year. So there's something I've noticed there. So these particular figures are wrong. So these particular figures are wrong. These particular figures are wrong. These particular figures are wrong. So remember, we've been told in this case, it was cash received on the contract in the year. not to debt. But remember, you are saying cash received to debt. So in the first year, it was actually in this case how much? 80. So it means the cash received to debt for the year 2015 will be how much? The cash received to debt for the year 2015 will be how much? It will be 170, then 240. So thank you very much. 170, 170. So for the final year, it was actually 70. So we add 70 here. It will actually be 240. 240. So we can be able to correct that one. So the cash received to debt, because what we've been given in the question is the cash received in the year. So in each and every year, but here we are lessing the cash received to debt. So in the first year, 2014, waliwalipa, huyu client alimlipa 80. In the second year, akamlipa 90. Inamaanisha, when you combine the 2 years, by the end of the year 2015, itakuwa 80 plus 90. By the end of the year 2016, itakuwa 80 plus 90 plus the final amount, which is actually 70. So it becomes 240 to debt by the year 2016, and kwa amemlipa 240. So you can be able to make that adjustment before, in this case, we get now the WIP, or the work in progress, the work in progress. So the work in progress here, it means it will be 7.5, which is actually a negative, Then in this case, the WIP for the final year, it will be 10. I think it will be 10. It will be 10 like that. Then we can, in this case, our trade receivables or trade payables. So we say to get the trade receivables or trade payables, you take the billings, the billings to debt, you less the cash received to debt, less cash received to debt. So the billings to debt you've actually been given. When you talk about billings to debt, is what this contractor had billed the client to pay. So what he had billed the client to pay in this case, for the year 2014, it was actually, so we are being told that the billings made during the year on the contract, it was 90, 160. So in the first year, it will likely be 90. Then in the second year, they billed 100. So it means for the year 2015, the billings to debt will be how much? For the year 2015, the billings to debt will be how much? It will be 190. It will be 190. It will be 190. And the billings to debt for the year 2016, the billings to debt for the year 2016 will be how much? Because in the year 2016, they billed how much? 60. It will be 200 and, so the billings for the year 2016, it was actually 60. It will actually be 200 and, is it 50 or 60? 250 or 260? Is it 250 or 260? Irene, 250 or 260. So the billings for the year 2016, it was actually 60. It means it will be actually be 250. 250. So in this case, for the cash received to debt is already here, which you've already computed. So it means in this case, this one is 80. This one is 170. This one is 240. And therefore, in this case, our trade receivables here, it will be 10. This one will likely be 20. And this one will likely be 10. So that's what you'll be able to recognize as trade receivables in the statement of financial position extract. So it will be 10, 20, and 10. And of course, now in this case, you can see this one is similar to this one. So we said in this case, this is the work in progress in the final year. So it means this work by the year 2016, huyu contractor hakuwa amefanya. So inamaanisha hakulipwa. So bado anadai. So from the client, there's still a receivable of 10 in terms of the contract price, because the reason is because he hasn't performed this work. Maybe ili delay kavuka mwaka kidogo 2017. There are timings in terms of the contract hazikuingiana. Kulikuwa amebakisha, it was a road. Maybe what was actually remaining is to put markings on the road. That is what was actually remaining. So they had to carry it forward to the coming year. So they were not paid until they completed. So you can see the work in progress here is 10. And of course, what he's still having to claim is actually what? 10. Is actually 10. So remember, we said if it happens that the billings to debt the difference between the billings to debt and the cash received to debt is actually a positive, it simply means that in this case, it is actually what? Trade receivables. What about in this case, if it is a negative? We said it will be what? What about in this case, if it is actually a negative? This one is a negative. We said it will be what? It will be a trade payable, because in this case, it means the client or the contractor, there'll be an amount maybe he would have actually been overpaid. So he would have been actually been received a lot of cash. Let's say, for example, here, if he had received, in this case, 100 million. So it means there would have been a negative of 10. So the client actually paid him in excess. So he's actually claiming from him how much? 10 million. And if in this case, there's someone claiming money from you, you are in this case what? A creditor. That person is actually a creditor. That person is actually a creditor. And therefore, in this case, in your books of accounts as a contractor, you recognize a trade payable. A trade payable. So that is in this case how you could have been able to handle that one. You could have been able to handle that one. You could have been able to handle that one. Handle that one. Yeah, so there's another one which I told you you have a look at it. I don't know whether you were able to look at it, but I think we'll be able to look at it later on, maybe when we are doing blocks or something. But I want us now we look at just still the same topic, topic number two. Topic number two. I want us to start looking at, we look at another area which they might end up having to also test in the exam. It is known as hire purchase. If you look at your topic number two, there's that area we are calling hire purchase. Remember, I told you we'll focus on topic number two. We finish the key areas there in terms of computations. Then I think we can be able to look at another topic. So I want us to look at, in this case, hire purchase, accounting for hire purchase, contracts, accounting for hire purchase, contracts. So accounting for hire purchase. Accounting for hire purchase, contracts. 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 So this term hire purchase, you must have heard about it. You must have heard about it previously. Maybe in your mathematics in high school, probably you might have learned about hire purchase. Hire purchase. In your studies for mathematics, either in primary school or maybe high school, you must have heard about this particular term here, hire purchase. So when you talk about hire purchase here, so it is simply a transaction or a contract whereby we have two parties. There are normally two parties. In this case, we have the owner of the goods, and of course, we have the hirer. We have the owner of the goods, and of course, we have what? The hirer. So under this kind of a transaction, the two parties actually agree, where the owner of the goods actually gives possession of the goods to the hirer. And the hirer here is able to pay a down payment. Let's say, for example, in this case, if the goods are to cost, in this case, 10 million, so the hirer is actually called upon to put in a deposit of, let's say, for example, 1 million. 1 million. Then the balance, he'll likely end up having to pay installment-wise. The balance of 9 million, he'll likely end up having to pay installment-wise. Maybe they can be able to say he needs to pay the remainder of 9 million in the next nine months. So that is the agreement. So of course, he'll take the possession of the goods. And for example, in this case, start enjoying the rights of use of the goods. If it is, for example, in this case, what? Maybe it can be, let's say, for example, in this case, you purchased a sofa set on hire purchase, So the seller here or the owner of the goods here will give you the possession. So you'll go with this at home and start having to enjoy the right of use of that sofa set. But now he likely call upon you, before you take it, you pay a down payment. You pay a down payment of, let's say, for example, a particular percentage of the value of these goods. Then the remainder of the balance you can be able to pay in installments. What normally happens here, it is that you realize, and from your mathematics, if you can be able to recall very well, between cash price and the hire purchase price, which one were you told ends up having to be more? Between cash price and, of course, the hire purchase price, which one were you told ends up having to be more? The higher purchase price ends up having to be more. The reason is because now in this case, you know, when you're buying on higher purchase, remember you are paying in installment wise. You've been given a lot of leeway, but now in this case, it simply means that in financial management, you learn about, in this case, what? The concept of time value of money. The concept of time value of money. So remember, if someone is to come today and actually end up having to pay me 10 million immediately, maybe after a period of 10 months, this value of the money would have ended up having to do what? To change. So probably in this case, a value of an amount of this wouldn't actually basically be the same. So what happens here, simply because you're having to be given, maybe in this case, a leeway, you are being given a leeway, they can actually end up having to, in this case, put an interest. The owner of the goods will put interest on this cash price. So there'll be a cash price. He'll likely put interest on this particular cash price, and therefore it means the higher purchase price will likely be a bit more. So it simply means that in this case, for us to get the higher purchase price here, it will likely quite obviously be the cash price of the goods. But of course, the owner would have actually put on it some kind of, like in this case, what? Interest. And therefore it means that in this case, the higher purchase price will be a bit higher compared to the cash price. So if a customer comes and buys on cash price basis, he'll likely pay 10 million. The one who buys on higher purchase, they would have put an interest of, let's say, for example, 10%. And therefore it means at the end of it all, after 9 months, he'll pay a total of 11 million. So that is the higher purchase price. There'll be, in this case, the cash price element plus some kind of, like in this case, what you're calling what? The interest. We're calling what? The interest. Then also something very interesting about hire purchase, you must have been told, or you know, that in this case, there's normally what we call what? Repossession of the goods. Repossession of the goods. That in this case, if this hirer ends up having to hire the goods, then he puts the down payment of 1 million. In the contract or in the transaction, they can, for example, include a clause that in this case, if it happens that this hirer is not able to pay for the goods, there can be the repossession of the goods by the owner. So remember, under hire purchase, the goods basically are still in the ownership or in the name of the owner or the seller until maybe the final installment is actually settled. Otherwise, if there's default in payment of these installments, there can be an agreement, or in the agreement, they can be able to, in this case, say that whenever, for example, in this case, the hire is not able to pay for the goods, they can actually be repossessed. So ideally, as you are looking at, in this case, accounting for hire purchase contracts, basically what we'll be looking into in this case, all the entries that we'll likely be talking about, they'll be surrounding this. They'll be surrounding how repossession is done and how do you account for it. They'll be surrounding, in this case, the aspect of the hire of the goods having to be a debtor during the 9-month period to the owner. He'll be a debtor kwa sababu sana mdai. Amemlipa tu 1M, but bado in this case akona 9 million ambaye hajalipa, analipa pole pole. So in this case, there'll be the element of, in this case, the hirer having to be the debtor in the books of the owner. If it happens that in this case he's not able to pay, there can happen what you're calling a repossession. So how do you account for it? Still at the same case, in this case, of course, there'll be those monthly installment payments having to be done. So how do you end up having to account for them whenever, for example, the hirer ends up having to do what? Make the payment. So basically, that is ideally what you're going to look into as we look at as to why, in this case, you can be able to account for a hire purchase contract, So you can be able to write this before we start doing some mathematics here, some very interesting mathematics here regarding hire purchase transactions or contracts. You can be able to write this about hire purchase. So you define, so we can be able to define it first of all. So definition. Let's define it first of all. Definition. What is it? Let's define it first of all. Definition. What is it? Definition. What is it? It is a transaction It is a transaction which allows, it is a transaction which allows for the acquisition. It is a transaction which allows for the acquisition of an asset. It is a transaction which allows for the acquisition of an asset. It is a transaction which allows for the acquisition of an asset by paying for the deposit, by paying for the deposit, by paying for the deposit, and taking possession, and taking possession of the asset, and taking possession of the asset, and taking possession of the asset immediately, and taking possession of the asset immediately, the deposit is paid. And taking possession of the asset immediately, the deposit is paid. Immediately the deposit is paid. Immediately the deposit is paid. Is paid. Full stop. The transaction involves two parties. The transaction involves two parties. The transaction involves two parties, i.e., the owner and the hirer. The transaction involves two parties, i.e., the owner, i.e., the owner and the hirer of the goods, i.e., the owner and the hirer of the goods, i.e., the owner and the hirer of the goods. The owner of the goods, the owner of the goods, the owner of the goods. Then you write this, then you write this. You can be able to write this. You can be able to write this. You can be able to say higher purchase price is equals to higher purchase price, higher purchase price is equals to higher purchase price is equals to deposits, deposit plus higher purchase price is equals to deposit plus all installments, all installments, all installments, or you can be able to say, or you can say, so the higher purchase price is normally what they have agreed, like what you're having to say, 1 million plus the 9 million of the other amount, or you can be able to say higher purchase price, higher purchase price, or you can be able to say higher purchase price is equals to the cash price, what you just indicated there, the cash price plus interest, the cash price plus interest. So this deposit plus all the installments will comprise of this, the cash price plus some interest which they have put on it. So if they have put the interest, and of course now in this case it is coming to 11 million, then they agree how much will be the deposit. Maybe in this case the deposit will be 2 million. Then the remainder of 9 million, they'll be able to pay in installments of 9 months. So we can also be able to say, or the higher purchase price is equals to the cash price plus the interest, And of course, I've already been able to indicate that whenever the goods are having to be sold on higher purchase basis, it means they won't sell at the same price as cash price. So the customer who comes in to buy at cash price won't pay that exorbitant price compared to that one who pays under higher purchase. That one who pays under higher purchase, under higher purchase. Under higher purchase. Under higher purchase. So we can be able to write now the methods of accounting for higher purchase. The methods of accounting for higher purchase. You can write another title. The methods of accounting for higher purchase. 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 Accounting for higher purchase. The methods of accounting for higher purchase. Methods of accounting for higher purchase. Then you write, there are two major methods of accounting for hire purchase transactions. There are two major methods of accounting for hire purchase transactions. There are two major methods of accounting for hire purchase transactions. I.e., then you write i.e., there are two major methods of accounting for hire purchase transactions. I.e., there are two major methods of accounting for hire purchase transactions. I.e., number one, the interest method. Number one, the interest method. The interest method. The interest method. Number one, it is the interest method. So what is the interest method? Under this method, you write under this method, under the interest method, what happens? Under this method, comma, sales are recognized at cash price. Under this method, sales are recognized at cash price. Sales are recognized at cash price, full stop. Under this method, sales are recognized at cash price, full stop. Sales are recognized at cash price, full stop. Full stop. Interest is computed separately. Interest is computed separately and considered as an income. Interest is computed separately and it is considered as an income. Interest is computed separately and is considered as an income. Remember, we've been able to say that hire purchase price is equals to the cash price plus interest. So when in this case we're having to prepare, for example, the income statement, we'll of course recognize the sales were at cash price. We recognize the sales were at cash. Remember, in this case, if you're coming up with the income statement, unaanzanga na nini Monica, unaanzanga na sales, una less cost of sales, then unapata gross profit. So tunasema, in this case, under the interest method, what happens here, it is that when you are reporting the sales in the income statement, we utaeka tu at their cash price. But utakumbuka in this case, still in the same income statement, what you realized as interest on these sales for the owner of the goods, it must be recognized as an income in that income statement. Remember, in this case, in the income statement, we have the sales, the cost of sales, you get the GP, you add any other incomes, and therefore, in this case, you actually end up having to less what expenses to get the net profit. So what happens here, it is that we're having to say, under the interest method of accounting for hire purchase transactions, how is the hire purchase element recognized in these books of accounts? You just recognize the sales of that item at the cash price, but you need to compute the interest on this item that you're having to sell on hire purchase basis as the owner of the goods. Then you recognize it as an income in your income statement. So that's what they're having to mean in this case, what? The interest method. So method number two, the sales method. 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 You write this about the sales method. Just write this about the sales method. You say, under this method, sales are recognized at hire purchase price. Under this method, sales are recognized at hire purchase price. So sales are recognized at hire purchase price. Under this method, sales are recognized at hire purchase price. And therefore, in this case, you can be able to see the difference. Under the sales method, tuna recognize in the income statement sales at higher purchase price. Unaona vile sasa vile iko Monica. So tunasema under this method, we recognize the sales when you are preparing the income statement at the higher purchase price. But remember the other one, ile ya interest tulikuwa tuna recognize at what? At cash price. At cash price. So therefore, in this case, it means under the sales method, interest atuta recognize kwa income statement kwa sababu we've already factored it in the higher purchase price. We've already factored it in the higher purchase. Iko ndani hapa. Sasa kama tuna report sales at higher purchase price, inamaanisha in this case under the other incomes, kwa income statement hautaongeza interest tena kwa sababu ushai capture ndani ya hii. Una recognize your sales at what? At higher purchase price. At higher purchase price. So you're having to say under this method, sales are recognized at higher purchase price. Therefore, you can be able to write in this case the gross profit. Therefore, you can say therefore you can write like this. So mlifunzwa hivi. Unaweka dot tatu. Therefore, the gross profit will be equal to, higher purchase price minus the cost of sales. Higher purchase price minus the cost of sales. Higher purchase price minus the cost of sales. So that's how in this case you'll be able to determine the GP. Then you write in this case, interest is not recognized. Interest, you finalize. So once you've written this, therefore the gross profit will be equal to higher purchase price minus the cost of sales. You write another final sentence hapo before tuanze kuangalia which kind of accounts are prepared. You write and say, interest is not recognized as a separate income. Interest is not recognized as a separate income because it has already been factored in, Hilda. It has already been factored in. So you're having to say, interest is not recognized as a separate income. Interest is not recognized as a separate income. Interest is not recognized as a separate income. So those are the two major methods that will likely be utilized. So interest is not recognized as a separate income. So which kind of accounts will you prepare? The accounts will you end up having to prepare here? Which kind of accounts will you end up having to prepare here? So the accounts that you'll actually end up having to prepare here. Which kind of accounts will you prepare? So accounts prepared under the sales method. So accounts prepared under the sales method, So you can write this case number one, we have the debtors account. Number two, we have repossession account. Number three, the other account you'll end up having to prepare is provision for unrealized profit. Provision for unrealized profits. Provision for unrealized profits. Provision for unrealized profits. So these are the kind of accounts you'll likely end up having to prepare. The debtors account, that's what I was having to say, that the hirer becomes a debtor in the books of the owner of the goods. Some of these goods anaweza end up a default. So watakuwa na repossess. Utakuwa na repossession account, which will complete the double entry. Because the debtors will no longer be there. Then you have the provision for unrealized profit. Sometimes they might actually be anticipating they would realize a profit. But in this case, they won't realize it. Remember, tunasema, saile unauza under the sales method, una indicate in your income statement your sales. You've indicated your sales, but these sales are actually on higher purchase basis. In higher purchase, umepewa to deposit. Maybe in this case, the item was going for 10 million. So you've already recognized your sales as 10 million. You've already recognized your sales as 10 million. But of course, on this 10 million, wamekupatia tu maybe in this case, how much? Maybe 2 million as a deposit. So wewe ulikuwa ushaandika kwa income statement yako kwamba in this case, utapata 10 million on that item that you sold on higher purchase because you are reporting your sales at higher purchase price. But in higher purchase, you've not been given this 10 million. Umepewa tu deposit. So inamaanisha kuna 8 million iko nje ambayo sasa tunai account ndani ya debtors. But remember tumesema kinaweza umana. Kinaweza umania huyo mwenye amehaya hizo nini. Labda alikuwa amehaya kufurahisha tu watu. Ati nyumba yake inang'ara sana, ako na sofa sets. Anahaya hivi, anagundua kulipa hizo sofa sets si mchezo. So kinamuumania, inabidi uzichukue, you repossess them. Remember, you are anticipating to get 10 million. But in this case, it means you haven't gotten the 10 million. So it means there's some kind of, like in this case, profit you haven't realized. Remember, vile ulienda na hizi sales, ulienda ukatoa cost of sales hapo, si ndio? Ukakuja ukapata GP. But sasa kwa hii 10 million kuna zenye umerudishiwa. Kwa hii GP inamaanisha kuna ile ukupata. Kama ulikuwa usha recognize in your books of accounts, of course, the month of January, February, things were going so well for him. He was paying the installments. So there was no any anticipation that this profit cannot actually be realized. But later on, kikamumania, kikamramba, ikabidi akurudishie. So what you had recognized as a profit, you've not realized it. So therefore, in your books of accounts, you must be able to eliminate this particular unrealized profit that you'd already recognized on the sales of higher purchase sales. On the higher purchase sales. And therefore, the importance of having to come up with these accounts, the higher it becomes a debtor. Sometimes you can repossess. So you need to maintain a repossession account. Then there can be some profit which you won't realize. Reason being, ulikuwa umemuuzia on higher purchase, usha recognize your profit, but ameshindwa kulipa. Kwa hii 10 million, amerudisha. Sasa inamaanisha hizo goods as what you had actually recognized as part of your sales, kimeumana, kimemramba, labda amelipa tu deposit peke yake, hiyo tu ndio itakuwa part of the profit. But the other one, you have to eliminate it. So it will be unrealized profit. And of course, we are going to see how do you determine this unrealized profit whenever now in this case, you start having to come up with the income statement of the owner of the goods under higher purchase transactions, So of course, we are talking about in this case, the debtors account. So debtors account itakaa namna gani? So we can look at how the debtors account will look like. How will the debtors account actually look like? So debtors account itakaa hivi. So we can have the debtors account. We can have the debtors account. Unaweza itengeneza debtors account. In the debtors account, you'll have, suppose you have shillings. In the debtors account, in this case, we'll have the balance brought down, which has actually been brought down at the start of the year. You'll put the amount there. Then, of course, now in this case, there'll be sales. So sales will actually increase the debtors. So unaona hapa. Of course, umemuuzia on higher purchase, but haja kulipa sana kuwa debtor. So it increase your debtors hapa. But of course, during the year, maybe some of these debtors may become bad debts. So ukiwa na debtors, kuna wale uliuzia, hawakulipa pesa yote, wakahama, wakaenda out of the country. Saizi ukiwapigia ni mteja, so you won't collect. So there'll be bad debts amongst these persons you sold on higher purchase. So there'll be bad debts. But of course, pia watakuwa na kulipa. Si watakuwa na kulipa installment wise, ulikuwa umewauzia on higher purchase, but sasa wameanza kukulipa. So hizo debtors zinaendelea zikipunguka. So in this case, you'll actually end up having to reduce them by the cash received from these persons who are buying on higher purchase. Then maybe unaweza repossess. So repossess, data anapungua. For example, kama ulikuwa unamdai hiyo 10 million tunasema, then hizo goods amekurudisha, umerepossess. So huwezi kuendelea kumdai hapa as a debtor, as that higher of the goods. So if you repossess, it actually reduces. When you repossess the goods, it actually also reduces your debtor. So there can be repossession that has been done. And therefore, in this case, it will reduce your debtors. So at the end of it all, you'll have like a balance carried down by the end of the year as to how much you haven't been able to collect from your hirers, from your hirer of your goods, who are actually your debtors as the owner of the goods. Remember, those who are purchasing the goods on a higher purchase, they become your debtors. Therefore, importance of maintaining this debtors account, sababu kuna repossession, wamekulipa, zimeongezeka. So you need to have this account. It will help you in this case to know how much are you anticipating to get from those who've purchased on higher purchase whom now in this case you recognize them as having to be your debtors as the owner of the goods. So these are basically the account itatokelezea. Tumesema kuna hii ingine inaitwa repossession. Huku kwa repossession nini kinafanyika huko? Huku kwa repossession, je, nini kinafanyika huko? Itakaa namna gani? Itakaa namna gani? Itakaa namna gani? So you can have the repossession account. So the repossession account. Repossession account. We can have the repossession account. So repossession account ndio hiyo. So remember tunaongelelea shillings. Tunaongelelea shillings. You're not talking about cows which are supposed to be compulsorily vaccinated. So we are talking about shillings here. So we need to indicate shillings. So in this case, we can have the outstanding balance. You can have the outstanding balance from this higher. So the outstanding balance, you'll be able to put the figure there. If there was any outstanding amount, you put it there at the start of the year. At the start of the year, then there can be maybe revaluation of the goods which have actually been repossessed. Maybe they have actually been revalued. It means it will reduce the outstanding balance here. The unrealized profits will also come here. Unrealized profit on these goods on hire purchase will also come here. Then we have in this case, if it happens that so we can have the total, If it happens that in this case, the outstanding balance is more than the revaluation and of course the unrealized profits here, you'll have a loss on revaluation. If it happens, the revaluation of the goods is more, you can get the goods, then when you revalue them, the value is actually a bit higher than even what you sold on hire purchase previously. Than even what you're having to claim from this particular debtor or the person who bought the goods on hire purchase. Remember, sa ile una repossess, kuna ile pesa alikuwa hajalipa. So alikuwa amelipa like 3 million. So ilikuwa imebaki 7 million. So that is the outstanding balance. So you repossess back the goods. But in this case, you revalue the goods unrealized. At that point in time, anakurudishia, the value of those goods, maybe in this case, it is actually how much? Maybe 8 million. So there's a revaluation here. Then, of course, there's unrealized profit that you never realized when you sold these goods on hire purchase. You'll have to also credit it in the repossession account. So if it happens that in this case, the outstanding balance that you are supposed to be paid by this hirer who wasn't mwenye hajamaliza, alikuwa amechukua sofa set kufurahisha watu but amerudisha, if the outstanding amount alikuwa hajakulipa, it is actually more than those sofa sets when you revalue them, and the unrealized profit you have not realized on the hire purchase sale of these sofa sets, then that is a loss on repossession. It is a loss on repossession. But if it happens that when you revalue the sofa set, the value is higher. So the outstanding amount is how much? Let's say, for example, 7 million. But when you revalue them, they go up to, in this case, an amount of, let's say, for example, maybe 8 million. So if this side is more, then it is a gain on revaluation. It is a gain on revaluation. A gain on revaluation. Of course, that account will likely appear like that. So when you start doing the accounts, ndio utaona vile zinatokelezea. So of course, there's something you're talking about here, the unrealized profit. So how do you get this unrealized profit? How do you compute the unrealized profits on the sale of these goods on hire purchase? How will you know as to how much you've not realized as a profit on the sale of these goods on hire purchase? So the unrealized profit is equals to unrealized profit. How do you compute it? Is equals to the outstanding amount that you haven't been paid. So the outstanding amount which you've not been paid, that 7 million we are talking about. So the outstanding amount, you take the outstanding amount, you divide by, you take the outstanding amount, you divide by, in this case, the hire purchase sales. The hire purchase sales was 10 million. The hire purchase sales, you multiply by the gross profit on these hire purchase sales. You multiply by the gross profit on these hire purchase sales. You multiply by the gross profit, you multiply by the gross profit. So hiyo unrealized profit unaongelelea utapeleka pale kwa repossession account, even the formula. This is how you get it. You take the amount yenye yako amekulipa, the point in time you are repossessing, that was 7 million, and the total hire purchase price, which was 10 million, you multiply by what was supposed to be realized as a gross profit on the sale of these sofa sets. And of course, in this case, this particular gross profit here, sinishawambia vile inapatikana. Sinishawambia vile inapatikana. In this case, you take this one is actually the higher purchase price, you minus the cost of sales. So that's how you get the gross profit. The higher purchase price, you minus the cost of sales. So with this, you'll get the GP. Then the outstanding amount in yako amekulipa 7 million. Then the higher purchase, you divide, you multiply with the GP, you'll get the unrealized profits. Unrealized profit. And of course, if you never realize that profit, it becomes like in this case, a loss in your books of accounts. And therefore, in this case, we'll see when you are coming up with the income statement, hii unrealized profit hii, huko kwa income statement, tutaitoa, itakuwa inapunguza in this case, our profits, overall profits. Remember in this case, tuliuzia tu hiyo sofa set moja. Na huyo client, akatu-let down. Akakuwa mteja, akarudisha hizo. But of course, tulikuwa tunauzia wengine walikuwa wanalipa. So overall, when you compute the profits for the entire business on this sofa set, a new client alikuwa anafurahisha wageni nyumbani, alirudisha, huyo ndio tu tulikuwa na unrealized profit kwa hiyo sofa set yake. So lazima to less in the overall income of the business, as we never realized that particular profit on the sale of that asset on higher purchase. So now in this case, we've talked about the unrealized profit. So we can end up having to now, in this case, see how you account for it, in the income statement, you can have, in this case, what we call the provision for unrealized profit account. That is the final account. Tulikuwa tumesema kuna accounts tatu. So the third account in this case is provision for unrealized profits. Provision for unrealized profit account. This one, this is how you come up with it. So in this case, if there was any unrealized profits from the previous year, remember you have to indicate it is shillings in millions. So you'll have to indicate if there was any balance which was actually brought down from the previous year. You indicate it here. Then you remember the repossession accounts to make credit na unrealized profit. So umeona to make credit na unrealized profit. So utakuja hapa utadebit hapa, in this case repossession account. That is how you complete the double entry of this unrealized profit. So the repossession account, you'll put it here, that amount you've computed. Then you'll have the balance carried down. Remember, what you get as a difference, you can take to the income statement now as an expense. This will be the balancing figure. So you take the unrealized profit at the start, the unrealized profit at the end. You compute that unrealized profits for the year. Ile yenye tumetumia your formula, uiweke hapa. Then what you'll get as a difference, this now becomes the balancing figure, which you will take to the income statement, which yenye nimekuambia sasa itakuwa kama expense. Expense. Of course, hapo una credit, but now in the income statement, una debit kama expense. So this one becomes the balancing figure, which you end up having to take into the income statement as an expense. So those are basically now in this case, the accounts that you'll be able to maintain. So I want us to take a break. Of 5 minutes. We should be back by 7:30. When we come back, by the time we are coming back, I want us to see whether we can be able to look at this particular question here. You open it. So by the time, it means by the time we are coming after the break, you should have already been able to open it, so that we look at how you eventually try to account for these higher purchase transactions. So open November 2017, question number 5, 5B. Open November 2017, question number 5B. So when we come after the break, we should be able to see whether we can be able to look at that question. So I think 7:30 will be okay. Yes, so we can continue. I don't know whether you've gotten the question. Confirm whether you've gotten the question so that we start November 2017, question number 5B. So confirm anyone who has gotten the question, November 2017, question number 5B. Chebrogei has gotten it. Ruth has gotten it. I can see one of our friends is saying we post it. I don't know whether it will be possible to post it, or someone has already posted on the group. So is there anyone who has been able to maybe post on the group? If you can be able to download it and post for a friend on group, it will be very much better so that we can move together, It's already on the group. So thank you very much. Thank you very much. So the question says we can go through the question together very keenly. We can go through the question together very keenly. Reja Limited is a mid-sized firm selling electronic keyboards both on cash and hire purchase terms. The following information has been extracted from the firm's books of accounts as of 30th of September 2017. So of course, we've actually been given, in this case, the TRIO balance there, where we have the share capital, general operating expenses, cash balance, cash recovered from the hire purchase customers, cash sales, hire purchase trade receivables at the end of the period. I think it's at the end of the period. At the start of the period, that is 1134. Property, plant, and equipment value for this business is 50 million. Accumulated depreciation on this property, plant, and equipment is 22.5 million. Retained earnings that were brought forward in the current year, we are accounting for 3.5 million. Provision for unrealized profits at the start of the year was actually 504,000. We have, in this case, purchases that were made during the year was actually 171,000. We have trade payables for the year is 40 million. We have inventory at the start of the year was actually 7.5 million. Additional information: the company's policy is to take credits for gross profit, including interest for hire purchase sales, in proportion to cash collected. It does this by raising a provision against the profit included in the hire purchase trade receivables not yet due. The cash selling price is fixed at 50%, and the hire purchase selling price is at 80% respectively above the cost of goods purchased. The hire purchase contract requires an initial deposit of 20% of the hire purchase selling price, the balance to be paid in 4 installments at quarterly intervals. The first installment is due 3 months after the agreement is signed. The hire purchase sales for the year amounted to 270 million, including interest. So that is including interest. Then depreciation is charged on property, plant, and equipment at the rate of 15% per annum. 1/3 of depreciation relates to cash sales. Operating expenses are to be apportioned on the basis of cash and hire purchase sales. So of course, what you can be able to get from the question, there's a mixture here. There are those sales they're having to make on cash basis. There are those sales they're having to make on hire purchase. If you look at, in this case, the TRIO balance, you are being given a figure of what the cash sells, which is actually a figure of 36 million. If you look at the additional information, you are given a figure of the hire purchase sales, which is a figure of 270 million. So there's those items of keyboards, they sell on cash basis. But it seems that the majority of their sales, they make on hire purchase, because you can see the hire purchase figure sales, the hire purchase sales figure is a bit higher, 270 million compared to 36 million. So they require us, in this case, to prepare an income statement for Reja for the year ended 30th of September 2017, showing separate columns for cash, hire purchase, and of course, combined sales. Then finally, you prepare a statement of financial position as of 30th of September 2017. As of 30th of September 2017. So we can look at how in this case you could be able to solve that one. You could be able to solve that one. So of course, when they talk about an income statement, of so much importance, ask yourself from this particular question, do I have the relevant figures to enable me to come up with the income statement? For example, if I'm talking about the income statement, I need to know whether I can be able to identify the sales figure. I can be able to identify the cost of sales. I can be able to identify any other expenses. So because that is what actually ends up having to come in the income statement. And of course, you've already been directed by the question. They want you in this case to separate the columns regarding those sales that are having to be made under cash and those sales that are having to be made under hire purchase. Then you combine them. So from the question, of course, you have the sales figure. So the sales figure for cash sales is 36 million. The sales figure for hire purchase is 270 million as per note number 4. As per note number 4, you can be able to see the hire purchase sales figure is actually 270 million. The cash sales figure is 36 million as per the trial balance. But now, what we don't have in this case, for us to, for example, get the gross profit, we don't exactly know. So what could actually end up having to be like in this case, what? The cost of sales. We don't actually exactly know what could actually end up having to be like the cost of sales for these particular items of cash, or in this case, items of hire purchase. So we can start with the workings, do some workings here. Workings. So working 1, so we can determine the cost of sales. We can determine the cost of sales. We can determine the cost of sales. So of course, as per note number 3, you've been told, sorry, note number 2, the cash selling price is fixed at 50% and the hire purchase selling price at 80%, respectively, above the cost of goods purchased. So if you look at the cash sales, so our figures are actually in thousands. The cash sales figure here is actually 36 million. Exactly 36 million. So this particular figure here, we're having to say they have marked up the cost of sales by 50%. So it means this figure we are talking about here is actually at 150%. And therefore, in this case, for us to be able to know what exactly could be the cost of sales, the cost of sales means will likely be at 100%. The cost of sales will likely be at 100%. So because that is what you're having to be told here, the cash selling price is fixed 50% above the cost of goods purchased. So the cost of goods purchased is 100%, but they add 50% on it to get now in this case what? The cash sales, or the cash selling price. And of course now in this case for hire purchase, so hire purchase, you've been told the sales is actually 270 million. So it's 270 million. 270 million, our figures in thousands. So this one is actually at 180% because they are having to say they mark them up by 80%. You can see the markup is actually a bit higher on hire purchase. It is 80, this one is 50. Is a bit higher. So it means that in this case, for the cost of sales here, they'll likely be at 100%. And therefore, in this case, we need to determine what could be the cost of sales. What could be the cost of sales for the two of them? What could be the cost of sales for the two of them? So of course, now in this case, according to your mathematics, what do you normally say? In this case, if 150% is equals to this amount, what about in this case, what? 100%. You do what we call what? Is it cross multiplication? So you take 100 over 150, you multiply in this case by 36. 1,000. So the same case here. Cross multiplication. I think you know the mathematics here. So it is 100 over 180. You multiply in this case by 270,000. So I want you to give me the figures here. What are you getting as the cost of sales for the cash sales? And what is the cost of sales figure for the hire purchase? So I can see 150 imetoka wapi? Ruth Nanjala. We look at note number 2. Ruth Nanjala, look at note number 2. The cash selling price is fixed at 50% and the hire purchase selling price at 80% respectively above the cost of goods purchased. So of course in the question I've already told you, they are talking about in this case the cash selling price. So the cash sales here 36 million, they are at 150%. So the cost of sales are 100%, but we mark up so that they can be able to make a profit of 50% over and above beyond, in this case, the cost of sales. So that's why you're having to get to 150%. Umeona? Na hii ingine ni 180%. Kwa sababu hii wana mark up na 80% from 100%. So what we are looking for is the 100%, which is the cost of sales, which you don't know. So for this one, I can see my friend says 24 million. So this one is 24 million. This one is 150 million. 150 million. So hope the figures are correct. Hope the figures are correct. Francisca has given us the figures. That one is actually 150 million. 150 million. 150 million. So that we've already gotten the cost of sales. So this cost of sales figure will actually enable us to get the gross profit, because what we'll end up having to do, we'll simply just take the selling price minus the cost of sales. The selling price minus the cost of sales, and we get the GP. Well, now in this case, we are coming up with what? With the income statement. So to got tumepata cost of sales figure. So that note was helping us to get the cost of sales figure. So what is also of so much importance, is for us in this case to determine what is in this case the unrealized profit. Unrealized profit. Remember, nakumbuka hapo nimewaambia unrealized profit lazima tuangalie ni ngapi. Unrealized profit lazima tuangalie ni ngapi. Lazima tuangalie ni ngapi. Lazima tuangalie ni ngapi. But before this, instead of having to do this one first, wachana na hii unrealized profit kwanza. Wachana na kwanza, we can prepare, before you do the unrealized profit, we can prepare the debtors account. Let's prepare the debtors account. Debtors account. Before you do the unrealized profit, wacha tutengeneze debtors account kwanza. Wacha tutengeneze debtors account kwanza. So we can put our shillings in thousands. Our shillings in thousands. So let's do the debtors account first of all. So this is account first of all. So if we look at the trio balance, unaona trio balance hapo umeambiwa the hire purchase trade receivables as at 1st of October. 1st of October ndio mwanzo wa mwaka. So hiyo ndio balance brought down. So the balance brought down. Remember ile format yetu ya debtors. Kuna kale ka format nimewapatia. Unakumbuka ka format? Kalikuwa kanaanza na balance brought down. So in this case, the balance brought down as of 1st of October, which is the start of the year, is 1134. 1134,000. 1134,000. 1134,000. Then in this case, we said you include in the debtors account the hire purchase sales. Remember nimewambia ukifanya hire purchase sales ni kama umeuza tu na deni. Kama umeuza tu na deni. So in this case, it means that the sales here, for the hire purchase sales here, the sales figure here for the hire purchase, we have it. Ndio hii hapa. 270, tumepewa 270, exactly 270 million. Exactly 270 million. Then still in the trio balance, I think we've been given a figure of how much we were able to recover from the hire purchase customers. You can see a figure there in the credit side. Is the fourth item. The cash recovered from the hire purchase customers. So in our format, you remember I told you need to be able to put here how much I've received as cash. Ujua wakisema cash received inamaanisha walikuwa wanapunguza hizi. Tulikuwa tunauzia na hire purchase wakaongezeka kama debtors. But kuna zile pesa tumekuwa tukiwa push, kupiga masimu, kuwasumbua, kuwatembelea, eventually wanachangamka. Wakatulipa sofa 157 million 734. 734. 734. 734. So we said in this case, if it happens in this case, you have like any items you're having to be told were repossessed, you need to, for example, credit any bad debts that have actually been indicated, you need to also be able to indicate, but you haven't been told those ones. So it means we'll have the balance carried down for debtors at the end of the year. At the end of the year. At the end of the year. So hii inakuja 271, 134. Hii inakuja 271, 134. 271, 134. What is the difference? What is the balancing figure there as the balance for debtors as at the end of the year? What is the balancing figure there? Moses, Susanna is here. Susanna, what is the balancing figure there as the debtors in the debtors account at the end of the year? Remember niwaambia kama kulikuwa na bad debts ungeweka hapo. Kama kulikuwa na items that were repossessed ungeweka, but hatujaambiwa, so unaachana nazo. What is the balancing figure there? I can see you're saying 116,400. 116,400. Karen Paul, aki hiyo calculator yako sijui umefinya figure gani hapo. Umefinya figure gani hapo. So you can see the majority having to say 113,400. Karen Paul, you can be able to confirm 113,400. So this is the outstanding amount from the debtors by the end of the year. So simply because you have this one, then now kuna hiyo sasa niliwaambia mungoje kwanza. Tunaweza sasa in this case tafuta hiyo sasa unrealized profits. Tunaweza tafuta hiyo unrealized profits. Unakumbuka kale ka formula niliwapea ka unrealized profit. Nilikuwa nimewaambia unrealized profits in this case, you'll take the outstanding amount from these debtors, you divide by the outstanding amount from these debtors, you divide by the higher purchase sales, then you multiply by the gross profits. So the outstanding amount, you can see by the end of the day is 113,400. The higher purchase sales is 270. Let me give you a test. What is the gross profit? Let me give you a test. What is the gross profit? Let me give you a test. What is the gross profit? So the outstanding amount from these debtors by the end of the year is this one. The higher purchase sales is this one. Sini yenye tumeona hapa ndo hii. But now, what is the gross profit? Who can tell us what is the gross profit? What is the gross profit? What is the gross profit on these higher purchase sales? Mbutia says 120. Karen Paul says 120. That is very brilliant. That is the brilliance of the year. So we'll be able to say here 113,400 over, in this case, 270,000. You multiply by the GP. The GP here, Nanjala, unachukua hii 270 minus 150. So GP tunasemanga, GP what tunasema in this case is equals to the sales, you minus the cost of sales. So this higher purchase sales is 270,000. You minus the cost of sales, which is this one you've already determined here, is 150,000. So unapata 120,000. So what is the unrealized profit? What is the unrealized profit? What is the URP? What is the URP when you do the computation? What is the URP when you do the computation? What is the URP when you do the computation? What is the unrealized profit when you do the computation there? When you do the computation, what is the URP when you do the computation? It is 5,400. It is actually 5,400. 5,400. So you've already gotten the unrealized profits. The unrealized profits, which will likely end up having to help us to come up with the income statement, So, of course, there are other items you've actually been told. For example, in this case, if you look at note number 5, you've been told depreciation is charged on property, plant, and equipment at the rate of 15% per annum on costs. 1/3 of depreciation relates to what? To cash sales. So we can do the computation for depreciation on equipment. So depreciation, so working for depreciation. So it is actually at the rate of, in this case, 15% on costs. So exactly 15%. The cost of property, plant, and equipment from the question, from the trio balance. Ukiangalia trio balance, rudi tu kwa trio balance. Square na mbio mingi. So rudi tu kwa trio balance. Unaona property, plant, and equipment ni ngapi? 50 million. Na kwa hiyo note number 5, tumeambiwa wana depreciate property, plant, and equipment at 15%. So you'll take 15% of these 50 million. 50 million. Remember, our figures are in thousands. Our figures are actually in thousands. You take 15% of that, you'll be able to get 7,500,000. But remember, kuna vile wamekuambia hapo, remember tunatengeneza income statements mbili. So in this case, you are preparing the income statement for cash sales and of course for hire purchase sales. So you are told 1/3 of depreciation relates to cash sales. So it means in our income statement, when in this case, we'll be lessing the expenses, 1/3, so they're having to be told 1/3 of these will likely go to cash sales. So it means that in this case, for cash sales, this depreciation will likely be 1/3. You multiply by this, 7,500, which will likely end up having to come to 2,500,000. So it means for hire purchase sales, the depreciation will be 2/3, which will likely be the balance, which is likely 5 million. So in total, it will likely be 7.5 million, which is the total depreciation. So remember, when you'll be coming up with the income statement, we have to remember that of this depreciation, 2.5 itaenda kwa cash side column ya cash sales as an expense. If 5 million inabaki, itaenda kwa hire purchase column. Hire purchase column. So of course, hope you've been able to finish. I want us to come up with the income statement. Chap, we come up with the income statement. Chap. Naona kuna watu wanataka kuingia FM. Kuna watu wanataka kuingia FM, but before tuende FM, aka ka concepts ka come up na income statement kasi tokome haki to come up nayo chap kasitokome kasipotele kabla tumalize. So in this case, we can come up with the income statement. So you have Reja Limited. Is Reja Limited? Income statement for the year ended. It is 31st of October, 30th of September 2017. In this case, umeambiwa you come up with the income statement for cash sales, hire purchase sales, then the combined. So there are 3 columns. There are 3 columns that you are coming up with. So you need to prepare. So remember, there are shillings in thousands. They are not cows for vaccination. So in this case, we'll start with the sales. So sales tuko nayo. Sales is kuleta shida. Sales tulikuwa tushapewa haki. So Nanjala, tulikuwa tumeambiwa hii ya cash sales ni 36 million. Hii tulikuwa tumeambiwa ni 270 million. Tulikuwa tumeambiwa ni 270 million. So the total there, I don't know how much you're having to get. I think you should be able to get 306 million. When you add the two, I love cost of sales. Hilda, tulikuwa tumecalculate haki. Cost of sales kwa kiwani tumefanya haki, tumefanya. Hii nimeona mkanipea figure ya 24 million. 24 million. Hii mkanipea a figure of 150 million. When you add the two, inakuja 174 million, like that. So we can be able to get the gross profit. Gross profit virahisi to the difference. So the difference here is 12 million. The difference here is 120 million. The difference here, you add the two, I think it's 132 million. 132 million. Then, of course, we have to recognize any other expenses. We have to recognize any other expenses. Ukiangalia in this case, compute depreciation hapa under working for, so kuna depreciation. It is under working for, so we less expenses. We less the expenses, depreciation under working for. In this case, it is how much for there? It is 2.5 million. This one is 5 million. So total is 7.5 million. 7.5 million. 7.5 million. Then you can go to your trio balance and try to identify any other expense we might be having. And of course, the other expenses we are having here, it is the general expenses. General expenses, I think you've been told the amount is 65 is the second item in the trio balance, 65 million. But as per note number, operating expenses are to be apportioned on the basis of cash and hire purchase sales. So in this case, we have general expenses. We have the general expenses, which in this case, the total is actually 65 million, is 65 million. But remember, you've actually been told that in this case, we are portioned on the basis of sales. So we'll take, in this case, for cash sales, so for general expenses, we can have, is it another working 5? For general expenses, apportionment, we can have the general expenses apportionment. Wamesema you apportion on the basis of the sales. So in this case, utachukua 36 million, for this is for the cash sales. 36 million over 306 million, you multiply by 65 million. So try to do the computation and you give me the figure. Try to do the computation. Try to do the computation. Try to do the computation and you give me the figure. And so you're saying 76, 46. So 76, 47. So it means in this case for the other item, that is higher purchase sales, you can get the difference. For higher purchase sales, you can get the difference, or you can take 270 over 306. You'll get the difference. What is the difference? Because the total is actually supposed to give you 65 million. The total is supposed to give you 65 million. 65 million. So 270 over this, you get 57,353. 57,353. So you can put them here. So you can come and actually put them here. So this one is 76,47. This one is 57,353. Like that, 57,353. Then the last item is provision for unrealized profits. Provision unrealized profit. The provision for unrealized profit, remember the unrealized profit is only on the higher purchase sales. For cash sales, we'll go and collect everything. So there's no unrealized profit on matters cash sales. It's only in this case on higher purchase sales. is only on higher purchase sales. Now, sasa in this case, the unrealized profit we've been able to compute, tumepata in this case, it was an amount of 50,400. So kuna working hapo, tumefanya hapo, is it working 3? The unrealized profit is actually 5,400. That is by the end of the year. By the end of the year, it's actually 5,400. But remember, in the trio balance, in the trio balance, there is 504. I don't know whether you can be able to see it. Provision for unrealized profit at the start of the year. So at the start of the year, that is 1st of October 2016, the unrealized profit was actually 504. Then by the end of the year is what we computed. That is on 30th of September 2017. It was actually, in this case, an amount of 5,400. So the difference actually becomes the expense for the year. Kwa sababu tukianza mwaka ilikuwa hapa, but ika increase. Remember, you are looking at the increment in terms of the expenses. So we should be able to get the difference here. That is 5,400. We minus, in this case, 504. For us to be able to get the expense in terms of unrealized profit that we're supposed to less from this profit realized under higher purchase sales. And if you get the difference, you should be able to get 49,896, like that. So 49,896, like that. So then you should be able to now, in this case, get the profits that were realized, 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 the profits that were realized. So that is how you come up with the income statements, the income statement. So hope you've been able to grasp this one. You look at the increase. At the start of the year, ilikuwa 504. By the end of the year, ni yenye compute 5,400. The difference is the increase in the expense, is what you end up having to recognize as the expense during the year in terms of unrealized profit for higher purchase sales. For higher purchase sales. For higher purchase sales. So you can get the difference. The difference should be able to give you the figure of the combined, the higher purchase sales and the cash sales in terms of what the profits. So of course, for the balance sheet, we will look at it in the next class, so you don't have to worry. I'll do a brief recap of this one. Then in this case, we should be able to look at the balance sheet in our next class as we look at another illustration on higher purchase, But try to comprehend what we've learned about higher purchase. You can reread it. You can review the video again to just be able to get a better understanding, because next time I look at another illustration, then we start looking at another area. So hope that is okay. So you can relieve some of you to go for the other classes. Otherwise, thank you very much. So let's catch up in the next class.